welcome to the Zero DTE podcast, season 2, episode 18. Today we're going to talk a little bit about volatility and the effects of volatility. So stay tuned, take some notes, and enjoy.
How you doing, friends? Ernie here, and this is 0 Days to Expiration, and this is episode number 21 of a new season, season 2. And today I want to talk about volatility, specifically what happens after you have an event that is provoking volatility. Is that the right word? I don't know. But what I mean by that is that it's pretty well known that anytime there's an event that's coming up, particularly one that has the potential to disrupt the market, the Fed's going to be releasing their minutes or doing a rate hike, or there's going to be a CPI or a big jobs report or something like that. Leading up to that event, implied volatility of the underlying index or whatever's being affected by that event continue to rise right into that event. Just keep on rising. And then when the event happens, everything will just spill over. It just volatility falls off a cliff. They call that volatility crush. So while those are relatively rare occasions, there are other times when you have that kind of volatility crush falling off of the face of the cliff. And you also have minor events like that every day. Every morning, there tends to be a bunch of volatility in the market, and then it falls off in a relatively ordered way, I would say. So volatility rises into the morning, the market opens, rolls over, and then comes down. And then it stays steady for most of the day until we get to the last hour. Some people call that the power hour. And then it rises up a little bit more, but not quite as much as in the morning. So we deal with these times as options traders, and generally volatility like the lifeblood of an options trader, and particularly those that are selling premium. When we have volatility, that inflates the premium of an option. And from a seller, that's something that you want to see. And the reason for that is that depending on how you're looking at things. Here's an example. Now, a butterfly, that's what we primarily trade on 0 DTE, and we trade it for a very specific reason. It's a very flexible strategy. You can make it as wide as you want or narrow. You can trade it at the money or push it out of the money. We like pushing it out of the money because we get a nice risk to reward, a nice asymmetric return potential. So we push it way out of the money. The other nice thing about it is that it's really great at collecting premium. And particularly with the 0 DTE, or the very last day of expiration, we like that in particular because on that last day, premium is decaying at an exponential rate. And if it's decaying at an exponential rate, that means that it's inflating our butterfly at that same exponential rate. So that provides all kinds of benefits. However, volatility can sometimes either help your cause or work against it. And so you have to be prepared for what can happen with your strategy. Now, fortunately, because it's the very last day of expiration, volatility has an effect, or can have an effect, but only for that first half of the day. Unless there's extremely impactful event that's coming up, like Uncle Jerry, chairman of the FOMC, gonna do a rate hike or have some kind of, presser, something where he's going to say something impactful. Or there's a bunch of Fed governors all on their speaking tour, and they're going to come up in serial fashion and bombard the market with their wisdom. Big CPI report that everyone is anticipating, that could happen as well. So anything like that is going to tend to make volatility rise right into that event. So let's take that first case. Economic reports that happen in the morning. Usually they come out around 8:30. The CPI is a good example of this. Volatility will rise right into that. Then after the report, the volatility might hang around for a little bit. The market opens a little later or an hour later. and then it drops off. But it could also drop off well before the market even opens. So in that case, you want to get ahead of that. And the reason why you want to get ahead of that is that you want to buy your butterfly when volatility is elevated, because that will mean that you can get a better price on that fly. That elevated volatility will tend to rise the whole butterfly up so that there's a smaller risk to get into that butterfly and also potentially give you much more profit. So it's all around good. You can generally trade a much wider fly, push it and maybe get it closer to the money and get it for a better price, depending on how much volatility has risen. Then once you're in the fly, volatility will drop. And because butterflies are said to be vega negative, meaning that they increase their value when volatility goes down, they like dropping volatility. If you're in that fly, then the dropping of volatility will cause the premium to decay faster and go up. Now that's good, like in the first part of the day. Once you get to around 2 o'clock, 2:30, something like that, time starts taking over, and volatility can't compete with that short period of time and the available volatility or available premium left in that contract right to the end of the day. No matter what, that's going to decay. You can't stop that. No matter how much volatility you inject into the market, you can't stop it in that last hour and a half or so. It's just not going to happen. So because of this unique property of volatility and its effect on premium and its effect on the primary thing that we trade, and that's the butterfly, we like to put the butterfly on early in the morning when volatility generally, for most mornings, I'm going to get to that in a sec, most mornings it's inflated because no one knows what to expect going into the new day. And then as things settle out, maybe around 10:30, it drops and then goes into kind of stasis. It gets really relaxed, and then premium explodes. So that's our general day. But today was a little bit different. Today we had an anomaly. And it confused a lot of people because I wanted to talk about why we trade in the morning. And I wasn't anticipating what happened this morning. So I said, hey, let's talk about trading in the morning. And then the morning transpired in a way that was very unusual compared to most other mornings. So this morning, volatility was high right at the open. And that's because we had a little gap down, and so it got elevated. But right after the open, it just dropped like a rock, just went straight down. So while it was dropping, people are trying to get in. They get into their price. And the price wasn't really moving a whole lot during this time. So people will get into a trade and they don't get necessarily a great price because they got it as it was halfway down. And then they get in and it just keeps on dropping. Now you might think, well, that's pretty good, right, Ernie? No. Here's the problem. We trade as something called the Batman strategy, and that is two butterflies on either side of the market. Now, when volatility is dropping, the effect that has is that premium starts rising on both of the flies. But between the flies, where you actually got in, it starts dipping. So this effect that we had this morning of volatility dropping very fast caused the premium on both sides of the fly to rise and then the middle dip. And so we're sitting right in the middle, losing money. And it's generally not that big of a deal because we understand that, look, if volatility is dropping like that, there's the tendency to price to move. And particularly if volatility is dropping fast, price should start moving up, right? Except for this morning, it didn't. It didn't until sometime around noontime when the market started to break out of this little funk it was in and started to move up. So it was a delayed reaction to the volatility dropping. So that made the trade relatively difficult to handle because very early on we get in thinking that, hey, everything's going to be cool. Volatility usually doesn't impact our P&L at all until around noontime, and then things start changing. Or if we have a sharp move in the market, it might affect the premium collection a little bit. But today was an unusual situation where volatility front ran the market. The market paused while volatility had dropped, and that caused our premium to get depressed in the middle, but elevated on the ends inside the flies themselves, which is what you would expect to happen. And price didn't move. We are sitting there with a fair loss on the debit in between those flies. And it was very confusing at first. You're wondering, what the hell's going on? This hardly ever happens. And particularly on the day that I chose to talk about volatility crush and what normally happens. So the day that's just the way trading goes, right? The thing that you expect to happen doesn't happen. When you don't expect it, it does. And what happens? You can't expect it. It's crazy. It's like really thinking that you know where the market's going to go, or you have some sort of market bias. You think that, but it never really pans out that way. So, like I said, on the day that I was going to explain how things usually work is the day that it decided not to work the way it usually does. And, it's pretty regular that we can expect implied volatility to be elevated in the morning and then slowly drop off over the day. But today, it just didn't do that. Don't know why. Yeah, today, Max says, today was a mess. It was unexpected. But overall, it's still not an issue with our trading. Because although it did drop down and it went down to a point where we would normally get out of a trade, what I had advised our members was to stick with it because we don't know what's going to happen. It's probably not going to move much further down than that because there's only so much that volatility can affect the trade in the first part of the day. And then the rest of the day, there's only so much time left. Volatility is going to decay at whatever its normal rate. So if it gets ahead of itself, it gets put on pause until that second half of the day happens. That second half of the day, or maybe the last third of the day, is ordered. It's going to have the kind of premium decay it's going to have no matter what happened in the previous part of the day. So we hang on for a little bit and wait and see what happens. And so price started to climb in the mid part of the day, right? But did it climb enough? It climbed enough to get us probably just above or just barely into profit. And so now here's our opportunity. Do we get out and hope that it keeps on rising and price moves into the profit tent? Is there a real good chance of that? I don't know. Or could it all reverse on us and go right back down into the pit in between the two flies and then end up in an even bigger loss? In a case like that, I would say that we're probably looking at a wash trade, just flat. Take what we can. If we can make a few bucks, cover the commissions, we're good, we're out. But a lot of people get confused in the beginning because of that immediate crush, and they think that that's when they have to get out. But it all comes down to what to expect and how volatility transpires and the amount of premium that's left. And you know that all the premium that's left has to decay to zero. It can't all happen in the beginning of the day. It could front run it, maybe get ahead of itself, but then it's going to naturally stall until we get to the end part of the day to go through that sort of ordered decay that happens at the end. And so that's generally why I said, hold on for a little bit, see what happens. If it works out, that's great. If it doesn't, then we either take a small profit, flat, or maybe even a small loss. And so that's how it went today. I was able to, now I got lucky. I entered the market a little later after this kind of weird event that happened in the morning, and I got a good price. And so I didn't suffer from that volatility decay, but it never really made it into my tent. It never really made it fully in there to make some money. So I made a little bit of money and it was okay. And that was a consequence of the position I have running this service. I am a very distracted trader. I am conducting interviews for new members, and I'm providing support, and I'm preparing for the live streams and all this other stuff. So I tend to be behind what everyone else is doing. And today that actually worked out for me in a good way. I don't mean to, rub that into the face of others who were looking at a day that wondering what the hell happened, as opposed to me pushing some money. But other people, they did fine. You just stay calm, work through the day. The cool thing about all of this is that there shouldn't be really any anxiety around these types of anomalous events with this strategy, because in general, we're trading extremely small. We put on strategies that have asymmetric returns. That means we take very tiny risks for much larger outsized profits. So in the case of when something like this happens, or if we're in any kind of losing situation, our losses are very small. It doesn't matter how small is expectations, they can get dashed, and people act the way they do. But in general, it's an easy problem for us to resolve. We know that the next day is going to be another opportunity. You just get by this, take a small loss, go on to the next one. So that's how things went today. And that's the story of Volatility Crush. Not only can you have these unexpected Volatility Crush days that apparently happened because of the gap, the small gap down we had on the open today on the SPX. And that caused this kind of weird crush. I guess after the open, the market still wanted to be bullish. So that caused volatility to drop, had a delayed action while the market was trying to figure out what to do. Our price wasn't moving, and then finally it got a kick on, and then it was off to the races. So that was the day today. Very interesting. Every day in the market is unique. Sure, some days are like other days, but it always seems that there is another thing that you say, man, I don't remember seeing that happening before. And while I've seen things like this happen before, you don't pay attention to it or whatever. Today was one of those particular days that happened just in the right order and just the right sequence that it was a little frustrating for traders. There you go. All right, so why don't we do a little roll call here, see who's online. By the way, if you like this content, please give it a thumbs up. If you wanted to know more about Volatility Crush, or you want to know more about trading 0 DTE with the SPX, options on the SPX, as well as the E-mini S&P, then give this video a thumbs up. Also, go down below and give our 4-week trial a try at 0-dte.com/try. You won't regret it. Believe me. Let's see. Who do we have here? We have Jay Hen. He's a regular. How you doing, Jay? Nice to see you. And is here with his double barrel hello. All Eyes is here. What is double ANFS? I have no idea. OG salute. And Max is here. Yeah, you were right. It was a bit of a mess. JD is here. Thank you very much. All Eyes says the Bitcoin is going crazy. What do you know? Yeah, I don't know. I don't know what to make of Bitcoin. It's off to the races. Cool. Maybe we can take a look to see what's going on with it. Oh yeah, it's not really going crazy. It made a little dip and then it's coming back a little bit. For those people that are all on a bunch about Bitcoin, that's big stuff. It might break out. Let's see. Nikula, how you doing? Thank you very much for the thumbs up. I really appreciate it. Lena's here. How you doing? And Richard Huber, good afternoon. How you doing? So I want to thank everybody for showing up. Tomorrow we'll have another show, but that's about all I have to say for today in terms of Volatility Crush and how volatility affects a 0 DTE trader. In general, like I said, major events sometimes provide an opportunity to get into an event early, take advantage of the Volatility Crush later. As a general rule, we get into our trades early in the morning because of elevated volatility, and then it drops later, enhancing or accelerating our position. And sometimes we have an event in midday like FOMC that we can play volatility and wait to enter the market before that event and then take advantage of the volatility crush going into the end of the day. There you go. See, all I says in comparison to the rest of the markets, it's pretty cool to see it uncorrelate. Yeah. Yeah, I never thought it was correlated anyways. It's a weird thing. All right. That's it. I want to thank you very much, and we'll see you tomorrow. If you're wondering what this is, you've never seen me with a ring on before, this is my Oura ring, and it helps detect and monitor my sleep patterns. Real big. I recommend it very highly. All right. Thank you all. Take care. Peace to you all. See you next time. Music.